All right, joining me on the line today is Bud Conrad. Bud is the chief economist at Casey Research, and he's the author of a new book entitled Profiting from the World's Economic Crisis, Finding Investment Opportunities by Tracking Global Market Trends. Bud holds degrees from both Harvard and Yale University. Bud, thank you so much for taking time to join us today on Follow the Money Weekly Radio.
I hope I can help your listeners understand how to deal with this complex world and protect themselves to eventually become profitable in their investing.
Well, Bud, when I saw the release of your book this year, I must admit I was intrigued by the title. I went out immediately and picked up a copy, and I was very impressed. It's a lot of research that you put into this book. This book is well over 400 pages, I guess over 450 pages long, and you open the book with an outline of some of the major economic headwinds that are bearing down on the American economy right now. And in particular, you talk about how both the budget deficit and the trade deficit are putting enormous pressure on our economy. For those who may not be aware of just how staggering these twin deficits have become, Bud, share with our audience why these imbalances are so dangerous to America's economic future.
Well, the most important one that starts the process is our own government's ridiculous spending. I love the comment, they're spending like a drunken sailor. And the counter comment, drunken sailors have to stop spending when they run out of money. I mean, there's almost no limit to how the government thinks it can now spend money since we've gone off redeemability of our currency. And they benefit first. So the incentives are all lined up for the government and their friends to get the largesse of government spending to spend even more. We're not in the kind of conflict of World War II, which was a destiny of nations and of the political systems of the world. Although we do have expensive wars right now, but our spending is matching as a percentage of GDP the extreme pressures of those days. And if in fact we did break out into more serious war, we'd be in worse trouble. But social programs added together, and particularly this demographic of the retiring baby boomers that all were born shortly after World War II, put an obligation for the federal government for Medicare and Social Security that's something like $70 trillion on a present discounted value. That will never be paid. In other words, my point is the government deficit is already broken and can't be fixed. I think Social Security could be fixed, but the medical system aspect of this is absolutely not fixed by adding more people to the rolls and not controlling the expenses. And my net of all that is we're beyond the point of no return on government spending. But there's another aspect to this. When the government spends more, people feel rich, and they feel they can spend more. They bought houses on the bailouts from the last recession before this one. We had a housing boom that matched the stock market boom, and foreigners supplied us with the cheap goods that made us feel good, Toyotas, TVs, everything else. And the wonderful symbiotic loop for the short term is that foreigners have then turned around and been their own vendor financing, that is, selling their goods to us in exchange for paper dollars, which they reinvested in our government deficit. That is, the foreigners financed us buying their Toyotas and TV sets, and they hold the paper debt of our government. So our government was able to finance its big deficits at low interest rates, and the dollar was strong with foreign demand for those treasuries. But obviously, we're selling off future claims on our own productivity should foreigners want to cash in that huge amount of accumulated trade surplus that they have and buy up our assets, in which case, not under the control of our own government, since these are foreign operations, we could have huge inflation if confidence were lost in the value of the future of our dollars. And I think, by my calculations, that value is already on the track of no return for being destroyed. So the combination of our budget deficit creating a boom, which created a trade deficit, which is then refinanced back into our government, is a sort of a feedback loop. And that's kind of important to bring up because I think of things the way my electrical engineering background taught me, to think of the consequence of the consequence, if you see what I mean. And we have this feedback loop that is now self-supportive that I think will become self-destructive once people wake up to the the fact that our king has no clothes. In other words, that our paper money is silly paper, and only that.
Well, Bud, there's another story that came out in the Wall Street Journal this week reminding us of this debate that's raging among economists about what's happened up to this point. Because we had, over the last couple of years, we've seen through the stimulus spending, the government has tried to prop up consumer aggregate demand. We've also seen that there has been a lot of attempts to prop up asset prices by the Federal Reserve. But what this has not led to, all of this new money that's been pumped in, has not led to inflation. And of course, that's what many economists or many people, observers, would have expected. And so there continues to be this debate among economists today regarding the entire monetary system. Some say that the Federal Reserve is going to be battling deflation in the not-too-distant future. Others, like yourself, say that severe inflation, possibly even hyperinflation, lies on the horizon for America. Tell us, in your opinion, why those who believe that deflation is the ultimate end game are wrong.
Good question. I spent a fair amount of effort on this in my book, in particular over the 2009 time period when I was weighing the size of the implosion of private debt. In this case, I mean mostly mortgages, because that's the biggest kind of private debt. It also applies to businesses, and particularly bankruptcy, or in the case of housing, foreclosure, when basically people can't pay their debts. That's kind of an extinguishing of credit, and since credit is the basis of money, that's a big deflationary pressure. It's real. We've seen it. Housing prices are down. Stock prices, while recovering some, are still down from their peak. Asset prices in general are not up. We do have deflation in asset prices. On the other hand, we do have reasonably high prices in basic commodities like food that have been going up most dramatically, with some scares about grain production in Russia and a few other things that have created a spike that is really not on most people's radar, but is real as well. And the debate is, will the debt implosion from bankruptcies beat out the debt creation as the federal government is stepping in to try and, as you pointed out from an economics point of view, increase aggregate demand? The idea is if the government spends when people and businesses find they are slowing their spending, can that improve the overall economic output? It's a debate, but let me put this in a perspective to simplify it for radio commentary. That is, we are in the middle of what I call the eye of the storm. We just went through a debt crisis. That debt crisis, a private debt crisis, was the implosion of particularly over-leveraged mortgages. People couldn't pay their mortgages. They were getting out by walking away, jingle mail, handing in their keys. The government came along and blew something on the order of magnitude of $3 to $10 trillion if you add the guarantees into the actual spending of deficits and Federal Reserve buying up toxic waste mortgages. That's a lot of money to spend. You do get some blue sky as a result of it. That's where we are now. But the problem is the government has taken over the bad debts. They're now on the government's books, meaning taxpayer, you and me. At some point, one loses confidence in the government's ability to spend forever and still keep the dollar strong. Similarly with interest rates. I think both that the dollar and the confidence in Treasury issuance will fall apart as we start the next winds of change of a storm of what I'm going to call a sovereign debt crisis or a currency crisis as the next logical expected step after the debt crisis of the private mortgage sector. And so what I am predicting is that the winds will scream the other side as people lose confidence in governments. We're seeing it just starting with a Japanese government intervening this last week to, for the first time since 2004 approximately, to try and keep their currency from rising. We're seeing it in Singapore coming along. And Greece, I think, was the bellwether of sovereign debt problems, much like Lehman Brothers was for the credit crisis that was the previous cycle. So I don't think we're anywhere near out of the woods, and there's a lot more to come from the next cycle of what I call point of no return on government debt, leading to a government sovereign debt crisis.
Bud, I think most of our listeners would sympathize with your views and would agree with you and would benefit from reading your book. And obviously, your book was written for investors, especially those who are looking to prepare for tough economic times. And let's just run through some various asset classes and get your opinion on each of these, how you believe, based upon your economic and investment outlook, how these are going to fare over the coming years. Let's just take, for example, the U.S. stock market, the equity markets. What is your near-term view? And then, of course, once we move out of the eye of the hurricane, what is that going to mean for the U.S. equity markets?
That's a fairly complicated one to start with. I have a model that I use for valuing stocks, and it's surprisingly neutral, despite all my negativity about the long-term economic strength of our country. The reason is that profits have been good with offshoring jobs, and companies' balance sheets are fairly strong, and interest rates are close to zero. Because as an investor, you sort of don't care where you get your return. You put it in a bond, you get a fixed return, you supposedly know what you're going to get. When you put in stocks, you don't know. You expect but a little bit, maybe higher return. But when interest rates are so lousy as they are now, you can put up with comparatively high PE ratios. We're at like 16 to 18 right now. That's high by historical comparison. But the interest rate competitive investment of your CD is close to zero. So you're willing to put up with what would normally be considered lousy returns. In the long term, stocks are somewhat of a claim on assets. So in some sense, they are investment that would protect you to some extent against inflation. So I'm not negative as you might expect from a person who's very negative about the prospect for the world economy. By the way, all these things I've been saying about the U.S. apply almost to every other country in the world. Demographics, retirement, government deficits. Deficits of the EU are terrible. The deficits of Japan are double our own. I have a whole chapter in the book on Japan. And it looks at the long-term history so we can get a better flavor of this. My net of all this is I'm sort of neutral on stocks, but with a minor bearishness that I don't trust that they haven't told us about all the bad stuff that's on the books of the banking system, and I would be more negative to financials than most. But that's sort of a neutral answer for all the complicated stuff I gave you.
Okay, well, what about energy?
I am a big bull on energy. I think the problems of limited fossil fuels laid down over 100 million years and being used up, half of it being used up in the last 100 years, present a real problem for humanity. We grew from 1.5 billion people to 6.5 billion people and became wealthy based on taking the work off the backs of humans and animals and putting it into fossil fuel as a machinery to do create our wealth. It's extremely important for humanity, not just for investment. And long term, not only the traditional fossil fuel, but the newest forms of energy. If you can find the right one that is the winner that takes off and hopefully solves our problems, that's also a good investment. Right now, the cheap one, and amazing to me, is natural gas. That definitely, in terms of BTUs and investment, I think has got to turn around and be an opportunity for us, but I'm bullish the whole energy sector.